Now that we've learned how to budget honestly and eliminate debt, we can move forward into the next stage, saving and investing. The very first step is to build a safety net. Most financial experts recommend saving at least 3 to 6 months of living expenses in an emergency fund. Think of it as your financial airbag. It's there to protect you when unexpected expenses come up so that your long-term goals stay on track. Once you have that cushion, it's time to look at investing. Here's a beginner's overview. First, why invest? Saving money is important, but money sitting in a savings account doesn't grow much. Even a high-yield savings account pays about 4% interest, which sounds decent, but if inflation is also 3 to 4%, you're basically just breaking even. Over time, your money loses purchasing power if it isn't growing faster than inflation. That's why investing is critical. It allows your money to grow beyond inflation and start working for you. First investment option, the stock market. Historically, the stock market has averaged about 8% annual growth over the long term. That doesn't mean every year will be 8%. Some years are way up, some are way down. But when you zoom out over decades, stocks have consistently been one of the best ways to grow wealth. Some stocks also pay something called a dividend. This is when a company shares part of its profits with shareholders. Dividends can be a great source of passive income, especially if you reinvest them back into buying more shares. Over time, reinvested dividends can significantly boost your returns. It's important to note, though, that while dividends are powerful, it takes a relatively large amount of investment in dividend-paying stocks to see life-changing or lifestyle-supporting income. They can be a great supplement, but they usually aren't a quick path to financial freedom on their own. Second investment option, bonds. Bonds are loans to governments or corporations. They usually offer lower returns than stocks, but also carry less risk. Many investors use them to balance out risk in their portfolios. Third investment option, real estate. Real estate can be a powerful wealth builder, but it often requires considerable money upfront. For those who don't want to buy entire properties, options like REITs, real estate investment trusts, provide exposure to real estate for a much smaller investment. Platforms like Fundrise make this possible. Though just to be clear, we are not endorsed by nor endorsing Fundrise. It's simply an example. Fourth investment option, mutual funds and ETFs. Mutual funds and exchange-traded funds let you invest in a collection of stocks or bonds, so you're instantly diversified. A simple index fund can give you exposure to hundreds of companies with very low fees, making it a favorite, beginner-friendly option. Keep in mind that these aren't the only ways to invest, but some of the most common. You also may consider Bitcoin investment or currency trading. There really are many options, but the most important thing is to educate yourself, have a strategy, and stay consistent. Let's talk about risk versus reward. Every investment carries risk. Generally, higher risk comes with higher potential reward. The key is balancing risk with your goals, age, and comfort level. Another important concept to understand is the power of compounding. This is where investing gets exciting. Compounding means your money earns returns, and then those returns start earning returns. Over time, this snowballs into massive growth. For example, if you earn dividends from a stock and reinvest them to buy more shares, those new shares will also earn dividends. The same goes for reinvesting gains from stocks or funds. Compounding is like planting seeds. The first tree grows, drops seeds, and those seeds grow into more trees, until you've got a forest working for you. This is why starting early, even with small amounts, can lead to life-changing results decades down the road. Finally, again, stay consistent. Don't stress about timing the market. Instead, focus on investing consistently, month after month. This approach, called dollar cost averaging, helps smooth out market ups and downs. Some final thoughts. The ultimate goal is to put your money somewhere it grows faster than inflation. If your money isn't working for you, you're actually losing it over time. Remember, I'm not a financial advisor, and this isn't professional financial advice. Everyone should do their own research and make the decisions that are right for them. But if you've built your emergency fund and paid off your debt, then investing is the next big step toward building wealth and financial freedom.
Subscribe to Think Like the Rich